In a research note out this week, Seaport Research Partners makes a call that the AI trade is indeed in the early days of a bubble driven by spending from 6 major companies: Amazon, Google, Meta, Microsoft, OpenAI, and Oracle. It comes as the tech sector has announced a wave of deals between some of these players. And joining me now to break down that call, Jay Goldberg, Seaport Research Partners senior analyst. Jay, it's good to see you. Thank you for being here. And, you say it's a bubble, but that's not necessarily a bad thing, or it's not necessarily imminent that the bubble is going to burst, I guess, is what you're trying to communicate.
That's right. I think we're in a bubble, but we're in early stages of the bubble, and you can still make a lot of money. Stocks can still go up a lot from here. But I think people just need to be aware that we're starting to get a little bit beyond the realms of rationality and into more sort of faith-based, belief-based investing.
Well, when you talk about those 6 companies that are so pivotal to this AI trade, of course, there's been a lot of concern that everything is riding on just a few players. And even among those players, I mean, OpenAI is unique, as you point out, in that it doesn't really have cash flow. The others do have good cash positions. But the other, we have the 6 up here, but maybe OpenAI should be in the middle of it rather than just one of the others, right? Because doesn't it seem like it's sort of the center of the web in some ways?
So I think that's the important thing that's taking place right now. In the last few weeks, we've seen 2, I think, big changes in what's sort of the pacing of things. The first is Oracle is now taking on debt to fuel its growth. And if you look at sort of historical bubbles, once you enter the companies taking on debt phase, that accelerates things. Debt is great on the way up. It juices things, but it's an amplifier. So it's good on the way up, and it makes things extra painful on the way down. The other big shift is that OpenAI has been, like you said, in the middle of lots of deal making, and it's an interesting company. It doesn't make a profit. It doesn't have free cash flow. It actually has pretty serious negative free cash flow, and they are the most aggressive out there signing deals. Just in the last 2 weeks, they've talked about adding 16 gigawatts of capacity, which is just a staggering amount of compute. And there are a lot of legitimate questions about where they're going to get that money from and what it's going to take. But critically, I think all the other names on that list are watching what OpenAI is doing and are afraid of missing out. They don't want to lose to this startup, and so they're going to spend aggressively to keep up with that. And that's why I think this bubble it'll keep growing.
And as it keeps growing, I mean, in the past, when we've had bubbles, there's always sort of a precipitating event, even if it's a small one, that causes the house of cards to come down, to mix my metaphors. How could that possibly play out this time? What should investors be watching for?
So I think there's a lot of ways that it could fall. In particular, once you start adding debt, then you have timing becomes really important. And I don't think this is, I don't think any of the companies on the list other than OpenAI have problems with credit or making their debt payments. But there are lots of other entities sort of below them, right? You go first to the neoclouds, companies like CoreWeave and Nebius and Crusoe and Lambda. They're all taking on a fair amount of debt to finance this. And then beneath them, there's another layer of special purpose vehicles and smaller funds, smaller companies that are building all this. And it's not quite a house of cards, but we are dealing with smaller entities that don't have strong balance sheets, that don't have strong cash flow, and things. It's easy to see them getting tripped up and causing wider spreading problems.
Jay, just quickly, since we're in a rate cutting cycle, couldn't that extend this whole AI spending cycle too? Even if people are taking on debt, if they're taking on debt at a lower cost than they would have yesterday, maybe that helps.
Absolutely. Rates coming down helps all this, and it will keep going. I certainly wouldn't be short too many of the stocks in this sector. Even NVIDIA, which I have a sell on, I think of that more as an underperform than a sell. I'm not telling anyone to short NVIDIA today, but I think it's important to just be very sober and go into any trades with your eyes wide open about what the risks are. Again, people can make a lot of money in a bubble. Just be careful of how levered you get and timing on things.
So you put in this note what you call Jay's slightly unhinged list of AI companies, because it's a long list, right? And it kind of like, it's not just those 6, it's all of those different layers that you talked about, the neoclouds, the service providers, networking companies, for example. So just to make it a little more succinct, like what do you think, if you don't think NVIDIA, you think NVIDIA is not going to relatively perform versus the others, where do you think there are those opportunities?
I think the big opportunities right now are in three areas. One is the neoclouds. CoreWeave, Nebius are both public. Some of the others may come public later next year. Uh, they still have a lot of potential deals that they could bring in, and the market likes those. I like the storage names, Seagate, Western Digital, SanDisk, NetApp, companies that we haven't talked about in a long time. But you look at some of these generative video apps like Sora, you're gonna need a lot of storage to hold on to all of those. And then the networking names, CoreWeave, NVIDIA and Broadcom are the biggest networking chip names out there, but there are lots of others. Credo, Astera Labs, AIP. There's a whole bunch of interesting names on this list that I think will participate in one way or another in the network build out.
There's a lot of things, a lot of ideas that people can invest in right now. Jay, thank you so much for joining us. Appreciate it.
Thank you.
Markets have traded at records throughout 2025, with the Nasdaq notching a fresh intraday high today before it turned negative. This has all sparked concerns of a potential AI tech bubble. My next guest sees some similarities between what happened in 1999 and the current rally. I want to bring in Jurrien Timmer, Fidelity Investments Director of Global Macro. Jurrien, it is always a pleasure to get some time with you, so we appreciate it. I do want to get to the 99 parallels, but before I do, the markets seem to kind of have forgotten about the U.S.-China trade deal and that there may be some potential rockiness between now and getting a deal done. Do you think that that's a mistake? Do you think it's something to be concerned about? Or do you think, it's full steam ahead no matter what?
Well, certainly following the tariff tantrum in April, the market does seem to have moved on, saying, okay, 10% tariffs, not the end of the world. We got the one big beautiful bill. We got the whole AI phenomenon, adding a lot of tailwinds. And so, yes, but the China tariff negotiations, never really concluded, right? We're on the second 90-day reprieve. And so, I guess it's a reminder that the tariffs have not completely gone away, and we still don't really even know who's paying for them, right? I mean, the sense that the exporters would bear the brunt of tariffs doesn't seem to have played out. It seems to be a very small amount, and then the majority of the cost of what basically are import taxes are borne by American consumers and importers. But again, profit margins are rising because of the AI boom when they otherwise might have been falling because of the tariff. So it's a reminder to have a nuanced view about these things, that it's never just one thing monolithically driving outcomes. It always is a mosaic approach. And here we have a number of cross currents happening at the same time.
Yeah, most definitely. Jurrien, I just wanted to highlight one more thing that the president posted in this post, which again is quite long, but he says, I was to meet President Xi in 2 weeks at APEC in South Korea, but now there seems no reason to do so. And this is something the markets had seized on as a reason for optimism, that progress was being made. Now, who knows if this is bluffing, if they are going to end up meeting in the end. But I guess as we're navigating all those cross currents, is this one more reason to maybe hedge in this market, hedge the AI boom that we've seen, and buy protection, whatever form that should take?
It's always good to have, obviously, a balanced, diversified portfolio, and it's actually a very good thing that this year the market rally that in the U.S. started 3 years ago next week really has broadened to the rest of the world, not just China and emerging markets, but developed markets, Europe and Japan. So that is a pretty good hedge right there, even though they're all different equities. But you can buy similar fundamentals in Europe and Japan now in terms of earnings growth, the growth in the payout, which is the dividends plus buybacks. That's the share of earnings that investors actually get back, and you can get all that for a fraction of the value of the valuation. And so there are ways to hedge. Obviously, bonds are a traditional way some cash. Gold certainly has been a very effective one as of late. But to try to time entries and exits over headlines is always a very difficult thing. We saw how bad the headlines were earlier this year, and the market, in its relentless pursuit of price discovery, read those headlines, and we fell 21%. And I think the markets are now like, okay, if it happens, then I'll react. I'm not going to react just on headlines. So who knows? Maybe this is the art of the deal. But right now, I think the market is mostly focused on earnings season, which is starting next week, and whether the acceleration in estimates that we've seen since April or May will continue to bear fruit.
Do you think that they will, Jurriën? Do you think that we are going to see, the banks usually kind of kick it off, or there's more banks than not in that first week. Then later we get into tech, which has been driving most of the earnings growth. Do you think, given that we continue to see stocks mostly push higher, that they're going to live up to those expectations?
My sense is that they will. The last few quarters saw a very impressive bounce. We all know this is like the oldest game in the book, right? Companies guide lower only to beat estimates, so they under promise and over deliver, I should say. And the last few quarters saw a very meaningful bounce. And right now we look at the third quarter growth estimate for third quarter S&P earnings. That growth estimate has flatlined at 7% now for several months. And typically the bounce is at least 300-400 basis points. But in recent quarters, it's been more like 500, 600, 700 basis points. So my sense is, based on revisions, based on our own internal research, that we could have another solid quarter. And that would then be the third quarter this year where you would have double-digit earnings growth. And that's exactly what this market needs, because it's not cheap, and it needs to justify its valuation by producing the earnings.
Jurriën, we began by talking about the analog to the 1990s from what we're seeing right now. And certainly that's been much talked about, and the idea that we could see a bubble and a bursting of the bubble. What are you seeing as you make those comparisons? And if it is a bubble, how much further it can inflate?
That is the question, of the day, of course. And yes, I do like to look at price analogs with the caveat that they work great until they no longer work. But, a few years ago when we had our bear market here in 2022, I saw the parallel with 1994, which goes back a ways, but that was Alan Greenspan raising rates, and he did so without producing a recession. So he landed the plane, and that was it's not really a bear market. The market only fell 10%, but it languished for a year, and so that we call that a stealth bear market. So that bear market turned into a roaring bull market in '95, of course, driven by the early internet boom, and helped by the fact that Greenspan gave back 3 of his rate hikes. And so there are some parallels there with 2023. Again, no recession. The bear market was entirely caused by rising rates, and then the Fed was able to give back some of those rate hikes last year, and again a few weeks ago. And then the analog kind of pushes forward, and we just had that tariff tantrum in April, down 21%. And back in '98, we had long-term capital management, 22%. In both cases, the market came roaring back very, very quickly. And actually, the only other time other than this current episode that the market came back so strongly, so fast from a 20+% decline was that 1998 recovery. And guess what? Greenspan, cut rates 3 times, even though the markets had a ton of momentum. And, again, you can draw the parallel to the rate cut that we just had in a market that is making new all-time highs almost every day. And with this, narrative of AI now, internet back then. So long story short, there are some similarities, which is not to say that we're in a bubble or even going to be in a bubble. Certainly, I don't see any signs that we're in one now, although There are some signs that there's some froth coming into the market. If you look at non-profitable tech stocks are flying again like they did back in 2021. So certainly the elements are there, but again, you look at the leaders, the Mag 7, their meteoric rise is basically justified by meteoric earnings. They're trading at a 35 multiple, which is higher than the market, but they're not nosebleed levels the way we saw in 1999 or 2000.
I think the non-profitable tech point is a really interesting one, Urian. If you are looking for warning signs going forward, is that one of the key things that you're going to be watching, or what would you recommend that folks pay attention to?
It's certainly one of them. I mean, I look at a host of sentiment indicators, and there really isn't a lot of sign that sentiment has really gone to extremes yet. But, the non-profitable stocks or like the retail favorites, those will give us some idea about the speculative side of things because, again, those stocks by definition don't have profits. And, just like the internet boom, you can see in the AI boom that there is room for companies to kind of make lofty promises about the next killer app, and they get a free ride, and we don't really know what's going to materialize, and that sort of is what happened a little bit in the late 90s. So it's sort of, for me, it's exhibit A right now of seeing how far investors are willing to go to kind of buy the stocks with momentum without really knowing what's going to come next or whether that will come to fruition.
Urian, it's great to see you. Thank you so much.
Thank you very much.
Here's the topic. I can't think of two better guys to talk about this with. I want to get your take on the AI spending boom, because we do hear skeptics coming out.
Sure.
And these are not guys you can just dismiss. I mean, these are some very well-known, well-respected investors. And you're hearing them talk about maybe an AI bubble. They'll say, I'm hearing echoes of 1999. It's kind of some spooky stuff. I'll start with you, Daniel Newman. You hear this talk. What do you make of it?
Yeah, I think it's a lot of hot air in that balloon. I do think that there are little bubbles within the overall AI trade. Companies that have zero revenue, that are getting $10 and $20 billion valuations. You see it with some of the quantum names. You see it with some of the energy names that are just running really fast. But you look at the operating leverage and the strength of the largest, the Mag 7s, the Broadcoms, TSMCs, ASML. These are sturdy companies with incredible balance sheets that are making very intelligent bets on what the next 5 to 10 years are going to look like. And by the way, one thing on 1999, when in 99, the earnings were not even close to keeping up in terms of the companies and the prices of these stocks. It's not the same case. If you actually look at the line of how the earnings are matching with the revenue growth and the price appreciation, it is right in line. So I think a lot of people want it to be a bubble. I call it this is just the most hated rally of all time. But I actually think there is a really bright future, and that AI is really only in its beginnings, Josh.
So Patrick, I'm going to ask you the same question, but maybe I'll just frame it a little differently. How confident are you that on the other side of what's literally going to be trillions spent here, that investors are going to see, on the other side of that, they're going to see, okay, we're going to see material, meaningful revenue generation?
Yeah, so I was working at a .com during the .com boom and the .com crash. But I do want to buttress it on one end and just say I'm confident for the next, let's say, 2 years, as long as the hyperscalers can be funding their CapEx with cash before they have to be diving into debt or doing some equity financing. I feel really good about that. But to answer the question, I feel a lot more confident than I did during .com. There were so many different bad business models that were out there. Literally, if you have access to a browser, you can get the benefit of AI. We have connectors now, we have APIs, we have ecosystems that, quite frankly, didn't exist. Am I going to Babe Ruth this? Absolutely not. We should be asking these questions, and what we should be looking at are milestones of that downstream value.
What are the kinds of milestones you're watching, Pat?
Well, the first thing you're going to see is you're going to see a cool down in spending on CapEx with the hyperscalers, or you're going to see some, I would say, hard questions that investors are asking them. I think we have to start to see agentic frameworks that can be developed horizontally through the Microsofts, through the Googles, the AWSs, in conjunction with, I'll call it enterprise SaaS, where they are actually delivering higher levels of revenue and utility. On the consumer side, what I really want to see and what we should be concerned with is if we're not seeing increased revenue or new services based upon this. I feel pretty good, I feel better longer term than I do midterm, because I think if we get to AGI paying that $200 per month per a lot of people on the planet, will deliver incredible value.
What do you make of that, Dan?
These companies are making a big bet on the future. The problem is people are having a really hard time bifurcating now and 5 and 10 years into the future. They are saying things like, well, we're not getting AI revenue today. Companies like Google, Microsoft, Amazon, they're betting on a 5 and 10 year future. The reason they're making these deals with Nebius or with an Iron to get all the capacity, the reason that Sam Altman is working with AMD and working with NVIDIA, won't be surprised to hear an Intel announcement in the future. And the reason this is because he knows the only way he can continue to get the growth is to make sure he has all the compute capacity required. So this energy requirement has to be built out. The compute demand, literally every GPU and custom AI chip that can be built, Josh, will be sold. So if you look at what Pat said about the multi-year, it's not just the 2 years. The 2 years, we're going to continue to see a massive chip spend. But 5 and 10 years in the future, Microsoft needs to buoy its business model. And if it doesn't have the capacity to deliver these AI experiences in 5 years, this is how the big fall. And so they are making the investment now. They're putting their strong balance sheets and they're using their operating leverage to make sure that 5 and 10 years into the future, they can't be disrupted.
Patrick, you mentioned the hyperscalers. You think Amazon, Microsoft, Google. Increasingly, you would have thought of Larry Ellison and Safra Catz over at Oracle. I do want your take on this report today because it got a lot of attention.
Yeah.
Oracle was lower. The information, they talk about Oracle, they say that its profit margin in its cloud computing business lower than maybe what a lot of the street were thinking, that Oracle generated, they say, around $900 million in revenue from the rental of servers powered by NVIDIA's chips, but only around $125 million in gross profit. What did you make of that?
So Josh, you and I talked about this on this show, and what I said was that there's no way that that average for cloud is going to be the same as let's say their software, their SaaS business today. So I'm not surprised at all, particularly because they're breaking into this market. They had hyperscaler, they had infrastructure as a service, but they had never really gone big and laid down the investment. And what they're doing is, in a couple of years, they're making up for not investing nearly as much for the next decade.
I want to ask you, Dan, too, about OpenAI and AMD. That stock roared on that. When you saw that announcement, did you think, yeah, that's justified, that makes sense to me?
Well, first of all, just really quickly on the Oracle deal, I actually am very skeptical of the reporting. I'm skeptical of the math, the accounting, the way they tried to, because that level of granularity is not in the reporting. So that had to be extracted and extrapolated from that. And the idea that that kind of CapEx spend is going to return profit this quickly, it seems to be something you build FUD or you're kind of building a negative bearish narrative around. But I think Oracle knows, as I just said, they need to be betting 5 and 10 years. They're investing for the long tail. They're not only playing the game for the near term. That report makes it sound like that both NVIDIA is inefficient and Oracle doesn't know how to run its cloud business. The AMD deal was kind of brilliant. Lisa Su doesn't have the balance sheet to put $100 billion into OpenAI. So instead, the way they structured it, it gave very much a win-win. She gave a ton of incentive to Sam Altman to use more AMD. And all the people in the NVIDIA circles that are so surprised by this, they've been working together. This is not a new thing. Inference was the pivot. AMD has the opportunity to be a huge inference partner. And if Sam Altman is successful, deploys a ton of AMD, Sam Altman's going to have $100 billion or so in AMD stock. So I think it was a great way to play, great way to make sure AMD is in the game and it's going to contribute. But for all those out there that think this is a really bearish thing for NVIDIA is still going to get the lion's share of the volume.
On that, last question to you, Patrick. When you saw that, is that partnership, is Sam Altman in any way suggesting that there is no performance gap between AMD and NVIDIA?
I think what he's doing is suggesting that AMD is in the game, okay? And we're within percentages. right? Not miles. And it would make sense to me because architecturally, both of these solutions in this time frame are what are called a rack scale, meaning it's the entire rack, everything is optimized. And AMD, quite frankly, didn't have the technology, and NVIDIA does. And now I think they're competing on a more level playing field, and it's up to NVIDIA, which has done quite well, as every generation, it goes a giant step ahead, right? They rethink something, and they have to be cooking something for 27, 28. They're not going to lose tremendous amount of market share. But to Daniel's point, it doesn't mean NVIDIA loses here. But what it does is it means that AMD is a serious hyperscaler AI data center player. There were doubts, right? Because AMD didn't give a forecast like NVIDIA did, right? And they would never commit to a number, right? Now, I've heard Lisa talk through this, Lisa Su, and the number never would have been good enough for anybody, because even if you put it up against NVIDIA's, it would be a very small percentage. But now, right, I'm not going to say they're on equal footing, right? They're still 10%, 90% players right now, but I could see on a percentage basis AMD picking up some percentage market share. But to Daniel's point, doesn't mean that NVIDIA loses. They can actually both grow. I think you heard Brockman say this yesterday.
Very last question I want to squeeze in. We've been talking here about all the potential AI winners. As you look across the landscape, as both of you this, now and ahead, what are the kinds of companies, Dan, that you think, hey, they're at a structural disadvantage? These could be AI losers.
Yeah, I think the category that everybody's come to agree on here, Josh, is it's the enterprise SaaS and applications companies. They're at the highest risk. And here's the reason why. In the future, these agentic workflows that Pat mentioned, they're going to be able to, just like we do with ChatGPT, you're going to ask it a question, and it's going to be able to look across your entire data estate. It's going to then be able to abstract you an interface, and it's going to be personalized to you. Right now, when you use a CRM or any sort of ERP platform or an HR platform, predetermined or highly customizable, lots of consulting, lots of spend, lots of seats, and the way that whole business model works, I've been saying for a while, the software industrial complex is going to be reborn. So the winners of the SaaS era are going to have to make a really hard pivot. So the Adobe's, Salesforce's, ServiceNow's all under pressure. I think ServiceNow's done a pretty good job telling its story. I think obviously Salesforce is trying with Agentforce, but in the end, Google's saying build your agents with us and build it all with us. Yeah. And that is definitely creating new calculus for these companies that have had a multi-decade run.
Quickly, Patrick, you agree with that?
I do, and I want to characterize it. It's a foot race between what I call the horizontal agents from the hyperscalers versus the enterprise SaaS agents. They have agents too that are very vertical. And the bet that the enterprise SaaS companies have is they can do it quickly enough, less friction at a reasonable cost and a reasonable premium. Some of these enterprise SaaS companies are giving their AI away for free versus this other structure that says, I'm going to build these horizontal, I'm going to have these horizontal agents, and I'm going to save money because I don't have to pay the premium for enterprise SaaS. Enterprise SaaS is not going away. The question is its growth. And are enterprises going to give the extra money to the enterprise SaaS vendors for that AI magic, or are they going to invest in these horizontal agents?
I think some of it will go away.
Fellas, great to have you both here on set.
Thank you,
Awesome.
Josh. Appreciate that.
It. That was terrific. Thank
Yeah.
you. Stocks have been seeing some gains so far in October, with the major indices reaching record closes. However, our next guest outlines why there is reason to be cautious and what that means for traders. Bob Lang, explosive options technical analyst, joining us here now with the Options Playbook, sponsored by Tasty Trade. Bob, great to see you, especially on set, sir. Let's start here. So the VIX perking up, as it does tend to do this time of year, right? How do you play that, Bob? Are you concerned enough to buy protection on the general market?
Well, I look, Josh, great to be with you. So I look at volatility in terms of time frames, right? And when the market's been up for 7, 8, 9 months of the year, like it is this year, it tends to lead to bullish behavior to the end of the year. And when that happens, we usually see a suppression of volatility. Now, the VIX is hovering around 16, 17%, which is a little bit lower than normal. The average VIX is about 19, 20%. But it's a little bit lower than normal. It's really feeding into more money coming into the market. Lower volatility tends to make people a little bit more relaxed, a little bit more aggressive into the markets. I think that can be a little bit worrisome, especially since we're worried about some uncertainties coming out here, and anything could hit out of left field, whether it's tariff related or whether it's AI or whether it's something else or some earnings shortfalls coming up the next few weeks. I think it really behooves most people to have some protection on, and either buying volatility or else you're buying puts. Put options are very cheap right now. With the VIX been at 16, 17%. So I think that's
your bottom line is some caution is warranted here.
Absolutely.
Okay. I want to talk about AI as well.
Yep.
Lots of hot talk about an AI bubble from, or some very well-respected investors saying, "Hey, they hear echoes of 1999." What's your take on that,
Josh? There's always a bubble going on. There's always bubble somewhere. I go back to the late '80s, right? There was a bubble in biotech. In the late '90s, there was a bubble in .com names and technology.
Does the bubble have to burst for you to know there was a bubble?
No. In fact, actually, you know what? The people who identify bubbles are the ones who actually are not into it. I was in the bubble during the late '90s and the .com, and I was loving it. It was great, making lots of money. And I'm sure right now, if there's a bubble going on in AI, a lot of people making money. Are they complaining at all? Absolutely not. So, it's only at the end of the ride that people are getting upset and disgusted about. Look, there was some talk from Paul Tudor Jones the other day.
Sure was,
Yeah, I think yesterday he said, we're in a bubble right now, similar to we were
99,
in the
right?
99, 2000. And he did reference the period between October of 1999 to March 2000, where the NASDAQ went up 80%. Well, I remember that time. And I remember that a lot of short sellers got blown out of the water then during that 6-month period. So, I think you just have to keep it in context and keep the reference point is there, of course, that when the market blew up and the NASDAQ dropped 72% from the highs in March of 2000 to 2001. So you do have that reference point there, but I do think that we really don't have to fear the fact that we're in a bubble right now. It's just make money as you can.
Let's get to some trades. Sticking with AI, talk to me about Google.
Google. So this has been a stock that's been one of my favorites over the past few months, and it's up something 70% since the lows in April. It's kind of consolidating right now. I do like the chart here. If it gets above 250, 253, it's got some room to run. So I'm looking at maybe like a March call for Google, maybe even to January, a little bit shorter term. But I'm looking at a call maybe paying about $17 in March, and if it gets past those certain levels, about 253 to 255. This stock's got some leg to run, and I think that in 2026, this is going to be the year of Alphabet or Google. I think with a positive business environment, you've got lower interest rates coming in over the next couple months and into 2026, and then a deregulatory environment, and then also, we've seen Google come out and settle with the English government, and they got lawsuits with Europe, and I think even in the United States. They're going to be settling these lawsuits, and it's going to be a tailwind for the stock.
And OpenAI, they're not going to come in and just take search, Google's bread and butter?
I think that Google's got a real good foothold in this. And look, they're number one in search. They continue to expand that footprint in search. And there really is no competition for them. And I think going forward, so OpenAI is going to be some competition, but there's also other competitors out there too. There's Microsoft, there's Amazon, there's Apple too.
Speaking of Microsoft, you got a trade there too?
I really like Microsoft. It's created a nice little bowl-shaped pattern here, Josh, and it ran up. It had an unbelievable run in the summertime, came back down, made a low here, and it's making higher highs and higher lows, which is our textbook definition of an uptrend. And I do like Microsoft going into earnings season. I think that it's going to make a run past 550. And if it gets past that 550 marker, which is the old high back in early August, I think it's got to run to 600.
Bob, always great to see you. Appreciate your time in those trades, sir.
Thanks, Josh.
Wall Street assessing the optimism around AI with the heavy spending on artificial intelligence and its payoff. Yahoo Finance's Inez Ferre taking a closer look in the latest installment of the Investor Playbook. Inez.
Josh, one of the big questions this week is the AI trade overstretched? Have investors been buying too much into the AI trade? And are we in some sort of bubble? We saw earlier this week that Goldman Sachs said that this market is not in a bubble yet, pointing out that the companies with the highest returns are the ones with the strongest balance sheets. Also, UBS, a similar theme, saying that investors should stay engaged, pointing out that the companies of today that are leading the AI momentum boom are companies with a stronger balance sheet than their counterparts back during the dot-com bubble. And UBS saying that investors should buy the dip, except for today, there have been few dips to buy. If we take a look at our Wi-Fi Interactive, we'll note that okay, a lot of red on the screen today, but if we look over on the major averages and we take a look at a year-to-date chart, you will see that there has been quite a run-up on all three major averages, especially from the April lows with the NASDAQ, the S&P 500, and also the Dow, really in this V-shaped rally that we've seen. So that has begged the question, are these valuations stretched? And there are certainly some on Wall Street that have been warning about a stretch valuation for these markets, saying that we are due for a pullback, not knowing exactly what the catalyst could be, except now perhaps the catalyst is the tariff situation and the trade war between the U.S. and China flare-up that occurred and a fluid situation there. And one other point is that when we are looking at the earnings that are going to be announced next week, yes, Wall Street is expecting that the AI trade will continue, but Wall Street also anticipates and will be looking out for any companies that talk about tariffs, because even though the tariffs on other countries and it's been a fluid situation, they are certainly less than back in April. And so what will the impact of the final tariffs on certain countries? What will that impact on those goods from certain countries be for companies? That's the question to see. But still, Wall Street has already increased its price targets on the S&P 500, thinking that the AI trade is the one that's going to power the markets higher.
All right, thank you, Inez. Well, markets holding near record highs here as tech and innovation keep powering this bull run, but some fatigue setting in. Joining us now is Ross Mayfield, investment strategist at Baird, for his read on what is next. Ross, great to see you as always. Markets don't seem too concerned, Ross, about this government shutdown. I did see Ed Yardeni, Ross. Now, that's a well-known guy, right? He raised his year-end S&P 500 target, Ross. He goes back to 7,000. So Dr. Ed sounds constructive. You agree with that call, Ross? Does that sound reasonable to you?
Yeah, I like the optimism. I mean, obviously the market shrugging off, the shutdown is maybe not unexpected, right? These have not been big market or economic events historically. We could still get there, if we follow through on some of the threats for firing, the economic, the data, the labor market is already in kind of a soft spot. But as far as what's driving the bull market, the innovation trade, as we just heard, tech, nothing is slowing that down in the near term. Things feel a little bit tired under the surface right now, but it would be perfectly normal for the market to consolidate here in the next couple of weeks and have one of those classic Santa Claus rallies into year end. So would it be surprising at all to make a push towards 7,000? I don't think so at all.
Talking tech, Ross, I don't know if you saw these comments from Paul Tudor Jones, told CNBC today, Ross, said today's market domination, talking about how it's kind of reminiscent of the setup leading up to the burst of the dot-com bubble in 99. What do you make of those comments?
I don't think we should be all that surprised. I mean, his comments were, yes, it looks a lot like the late 90s, but this bull market could still have plenty of room to run. I mean, this is the history of the stock market, right? Booms and busts, right? It's never up in a straight line. You get, these super cycles that then you get overbuilding, over enthusiasm. Ultimately, then, you're paying too much for a share of earnings. Things it looks a lot more like dot-com bubble because it's tech at the center, but this is the history of the stock market, for the last 150 years. It was the railroads in the 1800s and autos. And so this is not all that surprising. I think we're more in the middle innings than we are in the later innings of any sort of bull market into bubble transformation. I think there's still plenty of strong fundamentals in earnings. I don't see the kind of sentiment that usually comes with a blow off top, right? Even comparing today to 2021 felt way more bubbly to me, just anecdotally in terms of sentiment. So, I agree with the general sense, but I don't think that should be all that surprising. That's just kind of the history of equity markets here.
How would you characterize valuations here broadly, Ross? How stretched are we?
Expensive, but not crazily so. I mean, the thing that's so different about now versus late 90s, and this is not an original point, but is that a lot of these companies that are at the top of the market, the big ones that have all this price momentum, most of them are really solid companies with strong earning streams, big moats around their businesses, and even the ones that are starting to invest a lot and spend a lot more than they had historically have these other businesses off to the side, right? If it's, maybe it's Meta with its ad business, so they can spend, on AI infrastructure because they have this core business that is just churning off cash. So valuations are stretched, but if you look at the S&P equal weight, it's something like 16, 17 forward earnings. I mean, it's expensive relative to history, but not so much so that you can't get into the market here. I don't think we know how valuation works as a short-term timing tool anyway, which is not good at all. So I don't think it's a concern yet, but it's something to keep an eye on, obviously.
What about this upcoming earnings season, Ross? Your expectations there? Is this going to be another catalyst for the market?
Yeah, I think so. I mean, look, you've got this market that's being driven by excitement around a theme. But again, it's being backed up by earnings. So every time you have one of these big companies come through and have, like an Oracle moment from a couple weeks back, that just blows expectations out of the water, it kind of gives more fuel to this fire. Now, again, could it ultimately, inflate into a bubble and pop somewhere down the road? Yes, but right now the earnings are strong, and it's not just tech. I mean, if you look at the financials, the industrials, I mean, this theme is kind of spreading through the market. And then on the flip side, the tariff bite has just not come yet. You've got profit margins for the S&P pushing towards all-time highs. You just have to stand back and marvel at the ability of U.S. companies to squeeze profit out of this kind of global economic situation, right? And it's pretty good, not just in the U.S. but abroad. And I think that's the thing that gets underlooked a little bit is, we're an economy of multinational companies, and outside of the U.S. is doing pretty well right now. Europe, Japan, China, there are places where a weak dollar is really helping juice profits. So I think it's more than just tech, but I'm excited for what I think is going to be a really nice earnings season here and another expectation beating earnings season.
Big picture, Ross. How do I want to be positioned in this stock market right here? What am I screening for?
Yeah, I do think all that enthusiasm said, I do think you continue to screen for large cap and quality over chasing any sort of speculative rally. I know small caps have popped on this rate news. I still think large caps are the favorite here, both because of the kind of spend and capital, building that you need to participate in AI. But also because I don't think rates are headed that much lower. I mean, the Fed is going to keep cutting, but we're in a higher for longer rate environment. We are not, in my opinion, returning to a 2010s kind of zero interest rate policy environment. I think the deglobalization and kind of the fiscal dominance narratives are too strong. So you've got higher for longer rates. You've got all this input cost inflation. I think it still is a really difficult operating environment for smaller cap companies. So I think you lean large cap, you lean high quality cyclicals. Again, I don't want to be chasing companies that aren't earning a profit, that don't spit off cash flow, because I think you need that to participate in this AI, kind of build out cycle, to retain your labor, to get a leg up. So I think you can give up a few points to the upside by sticking with high quality and large cap, but I'm willing to do that because I think that's how you survive the full cycle.
Ross, great to see you as always. Thank you.
Thank you.